This was the block maximum method. And then, oh yeah, we have to remember that, we are looking at the standardized values again. So exactly the way you would have done it in a CLT for averages, here you're going to do it for the maximum. Yeah. So can anyone remind me of what limitation of block maximum method did generalized Pareto distribution try to overcome?
So, ma'am, in the earlier case, if we divided our time into more blocks, then in that case, like if there was a certain point that we did not consider as extreme, even that was considered, that came into consideration as extreme. But through the generalized Pareto distribution, we can set a threshold, right? And only the differences will be considered, like the x minus u part.
Yeah. So is that why is that a limitation of is this particular limitation overcome by the generalized Pareto distribution? What do others have to say about this? So this is definitely something that we do considering whenever we're looking at, how many number of blocks we should try to create when we are using block maximum method. So what happens is whenever you're looking at the block maximum method, you always have to remember that you need only one and one maximum out of everything that you're looking at, right? So the number of blocks you create, you have a limitation on the number of maximums that you can choose, which again are equivalent to this number of blocks that you create. But what happens in generalized Pareto distribution is you can still look at, only the extreme values. So when Isha said that if you create more number of blocks to have more data values to analyze and make your model a robust one, what happens is you tend to choose values which might not even classify as extreme values. And here in generalized Pareto distribution, we specify a threshold, a priori, and then we just look at all the data values which take a value higher than this mu. And the data set that we form, upon which we will do our analysis later on, is, mind you guys, not the actual value of these points. It is the difference between the actual value and the exceedance threshold that we have set up. So this is known as, so this difference becomes the value which exceeds more and above this threshold, and that is what we try to analyze later on. So this is what we have, and again when we are looking at extremes, now we are trying to look at how far can you exceed this threshold and what is the chance of that particular data set being observed or that particular value being observed. So we try to derive the CDF for this U guy. And what is our U? Remember, it is the threshold value, okay? The threshold limit that you have put in up here. So X minus U is what you have to basically, try to figure out the CDF of. And then you also look at the basic CDF that is given to you guys in your books. Again, for two different kind of values of gamma that you can have. One for gamma equal to 0 and the other case where gamma is not equal to 0. And we also had a look at that, if we have gamma greater than 0, which is usually in the financial cases, what happens is this boils down to a Pareto distribution with some modified and with some changes in the values of these parameters. And that is why we have this name generalized Pareto distribution. And again, I guess we did have a look at its exponential one as well. And because of the memoryless property, we saw that it really doesn't matter, right? It still remains the same. So that was one. And then we tried to just derive its PDF. And this was the next topic that we were trying to, have a look at the end of previous lecture. So we were looking at, the ways we can measure tail. And again, remember, this chapter we started off with, saying that we do not care about the whole distribution, right? We only care about the data set, the data values that lie within the right tail of the distribution that we plotted, and we called that right tail data values distribution as the child distribution, right? And that is the distribution, that is the distribution that we are talking throughout, right? It is not the whole parent distribution, not the whole underlying distribution. It is the child distribution that we are talking about. And this child distribution only pertains to the tails. So this whole chapter is about tails, about the right extreme, about the basically about the events that are very rare, and if at all they happen, they might lead to catastrophic losses to the companies. And yeah, that is a risk. So that is why we care about it. And now we're trying to model it and trying to see if we can maybe somehow hedge against it, and maybe somehow, we can't necessarily say that this risk is never going to happen, but if at all it happens to us, at least we will be prepared somehow. So yeah, that's it. So the very first thing that we had to look at was whether the moments exist or not. And we looked at Pareto distribution, where we certainly knew that, sometimes the moments can become infinity. But then if we put a cap on the values of alpha, which in this case were alpha greater than 1 and alpha greater than 2, we are 100% sure that, these would never go to infinity. And then we would certainly have a finite moment, which would allow us to see what's happening. But again, these moments really don't say us a lot, because if you're looking at the expectation, we know it just defines the location. And if we are talking about the variance as well, it's really nothing about, the tails that we care much more about. So the next thing that we had to look at was something known as limiting density ratio. And wherein what I tried to do was put in two different densities and take a ratio of them to see which one of them has a heavier tail. And again, this is not a density ratio, this is a limiting density ratio. So I'm assuming that my x pertains to infinity. And this is where I'm taking, basically the tail behavior into account. Because when I'm saying that my x goes to infinity, I know that I'm looking at something here, right? Because this is my x-axis and it is increasing in right direction. So we know that when I'm talking about x going to infinity, and so I'm analyzing the behavior of this f guy and this g guy in the tail region, right? And that is why this is something of use, and this will help us to specify which one of these distributions has a higher tail and which one of them has a lighter tail compared to the other guy. So the thing that I was talking about previously, in your books, if you have a look, you just have an example of, a gamma distribution and a Pareto distribution. And I guess we discussed the Pareto alpha equal to 2 and alpha equal to 3 example. And we got our answer as infinity in the last lecture, right? So we got something like this. So we had f of alpha equal to 2 in the numerator, and we had f of alpha equal to 3 in the denominator. And we looked at its limit when x tends to infinity, and this was what? Infinity, right? So now, can you guys tell me which one of these has a heavier tail? Anyone? Which one of these has a higher tail? Sorry, as a heavier tail.
It's with alpha is equals to 2.
Yeah, it was alpha equals 2, right? So nothing much to discuss over there as well. And now let's move on to the third measure of tail weights. Just give me a second, guys. Yeah. So the third thing that we are looking at is something known as hazard rate. Has anyone heard of this before?
Ma'am, could you please explain the f of alpha, like f alpha equal to 2 part again? Like which one has a
Oh,
heavier tail?
okay, all right. So do you know what we're talking about when I'm writing f alpha equal to 2 and f alpha equal to 3? So these are basically two parameter Pareto with no specified particular lambda, but we know that the lambdas are equal in both of these guys. And we know that the alpha is 2 for the numerator part, and for the denominator part, the alpha equals to 3. And let me just pull up the book if I can. Yeah, so it was here. Can you see it? Can you see this? So this is my two parameter um, alpha equal to 2 Pareto distributions PDF, and this is my two parameter again alpha equal to 3 PDFs Pareto. Sorry, Pareto's PDF. So I know that, I mean, I can cancel this lambda and I'll be left with one lambda which I get here and 2 by 3, and all of these cancel and I'm left with only one lambda plus x in the numerator. And again, because we have limits only from x for x, I can take this out as constants. So I'm left with limit lambda plus x, and I know that if my x tends to infinite, my limit lambda plus x is also going to be infinite, right? And because this is just some constant multiplied with infinity, you're going to end up with infinity itself. So now what we have said is that this limiting value is equal to infinite, right? So what does it say? Whenever you're trying to compare, forget about this limit, and what you can do is just write f alpha equal to 2 upon f alpha equal to 3 equals to infinity, and then you can just rearrange and put this up there, and what you have is f alpha equal to 2 is nothing but infinite times f alpha equal to 3. So now, Isha, can you tell me which one of these two values will be the bigger ones?
F
So
alpha equal to 2.
exactly right, f alpha equals to 2 will have a higher value. So now again, tell me one thing. If I'm plotting this, I have x on the x-axis and I have my value of the PDF on the y-axis, right? And this is the value of the PDF at alpha equals to 2. So if I'm saying that at for any particular x, which I know again we're talking about here, so if I'm saying you that for any particular value of x, my f alpha equal to 2 value is going to be higher than f alpha equal to 3. Then which one of these two do you think will have a heavier tail?
By heavier, we are meaning fatter, right?
Yeah, exactly. By heavier, we mean fatter tails.
So f alpha equal to 2.
Exactly right. And that is what you mean when you say that, alpha equals 2 has a much sleeker tail. So that's it. I mean, again, this is just for representative purposes because here the difference is basically, even if this is 1, this is going to become infinite. So again, you cannot necessarily put it down like these two lines I have, but you get what I'm trying to say.
Yes,
Does
ma'am,
this,
got it.
does this make things clear? All right. Thank you very much for asking. Does anyone else want to ask anything else about what you have studied up until now? Okay, so then let us have a look at hazard rate. So I was asking if anyone has ever heard about hazard rate before. Do you guys have any idea about what hazard rate is? Is anyone here from engineering background? I mean, did you take like science in your 11th or 12th and you might have heard this term up there, or maybe just in general? Anyone? No? So have you guys heard of mortality rate? I'm sure at least the people who might have taken, the CM1 exam might have heard of mortality rate. Can someone please explain us what is mortality rate? Anyone? Have you guys not studied this before? Death rate, right? Someone said Savri, was it you?
Yes, ma'am.
Okay, yeah. It is exactly the same. So mortality rate, I mean, what does mortality means? We humans are immortal, right? Or are we mortal? We are mortal, right? So basically, mortality rate means the rate at which, someone is going to die. And again, whenever I'm talking about hazard rate, so whenever we are looking at mortality rate, I mean, we know we are, actually analysts and we care mostly about insurance sectors where the claims would be, at least if you're looking at life insurance, would be the deaths of people. And that is the mortality in general. But here, when I'm talking about hazard rate, I do not only take into consideration one kind of liability. I mean, mostly hazard rate, this term actually came into use for the first time in engineering. And what happens is, let us say you have a machinery and if it breaks down, so what is the chance that it will break down in the next second? And if you want to figure that out, that is known as hazarded because it would be a hazard, right? If that machine breaks down and the production line stops. So that would be hazardous to the company. And that is why we call this as hazard rate. And now if I were to write its formula, so basically in words, first of all, what it says is the rate of failure given that you have survived up until that point. So if we take the machine example, what I'm looking at is the rate of failure. So my failure would be here what? Machine being broken down, right? So what is the chance that this machine, this particular machine will break down and will stop working in the next second, given that it has been working up until now? So this is the thing that we are going to take into consideration now. And it is denoted using small h of x. And its formula is something similar, I guess. So again, this would remind you guys of reinsurance. And this is in a way a conditional distribution, right? So a conditional is something. So we are conditioning upon the chance that the machine hasn't yet stopped working up until today. So what is the chance, given this information, what is the chance that it will break down within the next period, right? So what happens is, let us say, uh, let us say that there is a probability, and again, let T be my survival function. Okay, so this is the time period my machine has survived and my machine is working for. So now I know that my T is for sure greater than X. All right. And what I want to look at is the probability that this T will be less than or equal to X plus H in the next time period. So when I'm writing H, it just means a very, very shorter time interval. And what you do is you look at its limit again when H is of course going to 0 plus, and plus is just to say that you're looking at times ahead and not back of X. So if I have X is, let's say today, you cannot be looking at yesterday. You have to look at tomorrow, and which is why you have a plus sign here. And this is how we define basically the mortality rate as well. So let us say if this is a survival function for an individual, then it would be a mortality rate here, which is denoted by mu x here. So what this essentially tries to measure is, you know, the chance that a person will die in the time period x plus h, given that the person has survived and the person is alive up until x. So if my x is today and if my h is, let's say, tomorrow, then I'm trying to see and analyze what is the chance that I will die tomorrow, given that I have lived up until today. So does this is this clear to everyone?
Can
And
you say it
remember,
once?
oh, okay. So what I meant was, whenever I'm talking about t being greater than x, I'm saying that I have survived up until x. So if you see, a big difference here is in the inequalities that I have, is in the inequalities that I have, right? So if you look here, I'm looking at t greater than x, right? And what do I have here is t less than or equal to x plus h. So what I'm saying here is the chance, okay, forget, I'm not looking at chance. This just t less than or equal to x plus h is saying to me that I will observe a hazard in x plus h time period, which is sooner to occur, right? Because I'm saying that x has already happened. So how do we know that, machine has survived up until x? Because we have observed up until x. And we know that h is a very, very small interval of time. So maybe just let me write here. H is a very short time interval. So again, whenever I'm talking about hazard rate, what does it say? It is basically measuring the rate of, a hazard being observed. And what is my hazard? In the machinery case, the hazard is that the machine will stop working. So I'm looking at the probability that my machine will stop working within the next second, given that my machine is working up until now. If my H is 1 second. Or let's say if we're talking about lives and if we're talking about mortality rate, then I'm looking at the chance that the person will die within the next year, given that the person is alive in this year. So over here, my H would be 1 year. Does this clear up things a bit more? So this is actually the mortality rate. And what we are trying to now care more about is the hazard rate. So hazard rate is just defined in this manner, and we will directly use this formula. So most of the times you will be given the distribution, and what you just have to do is substitute in the small f of x here and the capital F of x here, and you will get the hazard rate. So that's it. And it is basically, I mean, you can interpret it using the analogy of this mu x, which will just try to give you a sense of, what it means in terms of the probabilities. And again, if you try to basically do this thing as well, you will eventually end up with the same formula. But again, we don't necessarily have to take into limits and all those into account. So we just try to, we have this nice short little formula. And now let me maybe just pull up a book to show you guys one example. Yeah, so I was talking about this limiting density ratio question that they were that's given to you guys in your book. So it's for gamma and Pareto, and you guys, let me just have a look at it to get some idea. Yeah, so this is the formula of the hazard that we just looked at. So it's really easy. So here the question asks us to determine the hazard rate for the exponential distribution. And given the kind of probability that we were looking at, it was conditional probability, right? Conditioned on something that we have observed in the past. And now we're trying to see what effect it has on the future, right? So again, whenever we're trying to do something similar with the exponential distribution, we are bound to think that memoryless property will kick in and it will render all the past useless. So that is what you see here as well. So if you look at the hazard rate for exponential distribution, and basically just substitute small f of x here and capital F of x here. So these e terms cancel each other out conveniently, giving you just lambda again. So what is the hazard rate? The hazard rate is actually, the actual rate of events happening within the exponential distribution itself. So it is no different than what it would have been otherwise. Because again, we know that there is memoryless property within the exponential distribution. And what has happened in the past doesn't anyway influence the chance of what's going to happen in the future or what we will observe in the future, right? So that's there. And next you have Pareto distributions example. So if you try to substitute Pareto distributions, PDF and CDF respectively, you get something like this. So you observe that your hazard rate, your small h of x, is something like alpha upon lambda plus x. So if I were to infer something from this, the only thing I can say is that if I increase my value of x, my h of x will decrease, right? Does everyone agree with what I have said? If I increase my value of x, keeping my alpha and lambda constant, of course. So if I'm increasing my values of x, my h of x will decrease, right? And again, what is my h of x here? My h of x measures the hazard rate, right? So what I'm saying is that as and when my x value increases, the hazard rate decreases. So again, I think what will help is to have a better look at the life scenario. And again, you will see two analogies here. So if you look at this paragraph and the very first line. So would someone want to read this for us? Anyone? I want you guys to read from here till here, first of all. Yes, Anvaya, would you want to do that? Just read this line.
Yeah, if the force of mortality increases as a person's age increases.
Yeah, that's it. Thank you very much. Does anyone understand what this line is trying to say?
So, ma'am, I guess it says that as the person's age increases, the mortality that means the death rate will increase because of the risks that might be associated with his age.
Yeah, it's precisely right. So that is all it says. So basically, as and when, so again, here the x that we are looking at is the person's age. So that is what we are plotting on the x-axis. And on the y-axis, let's say, I mean, we don't care about y-axis for now. So forget about that. The only thing we know is that if I increase a person's age, that person is much more likely to die now than that particular person was when the age was, a lower number, let's say. Okay, so that is what they are saying here again. Relatively few people will live to old age. So again, remember the T that we defined here. The T that we defined here was what? It was measuring a person's length of life. It was the survival function, right? It was measuring how much of a year a particular person has lived for. So if we are talking about T, if T is the variable of interest for us, and if I'm plotting T on the y-axis and X on the x-axis, so if I know that as and when my X increases, my force of mortality increases. So if a person's chance of dying is increasing, then of course, relatively few people will be, alive till the old age, basically till when X is a much higher number, right? So force of mortality is something about the death of people, And here we are talking about T, which is about, a person's length of life. So if we say that the death rate increases along the x-axis, then we know that as and when we reach towards the end of this x-axis, we're going to have relatively fewer people than what you would have here, which was a middle range for x. Does everyone understand this? So what it says is essentially that as and when my x increases, this quantity t decreases. So this is what you had previously, and now this is what you have. So relatively few people will live to old age, right? So that's there. And again, remember this graph, it is just for one person here, right? This T measures a particular individual's life. So not everyone's life, but again, if you know that death rate is increasing, then of course you can really say that, not many people would be alive. So that is what you conclude and that is what you deduce from this particular statement. So again, forget about if it's a light tail or a heavy tail for now. So we observe that, the graph would look something like this because we know that as and when we increase our x, my t value is decreasing because my force of mortality is increasing as and when I increase the person's age, right? So this was the assumption I made. Recall the if that we have here. And again, this particular scenario is what we observe in general. And the other if is a very counterintuitive, I would say. But again, just to put things in perspective, let us have a look. So if the force of mortality decreases as the person's age increases, so what this particular statement tries to convey is that as and when a particular person's age is increasing, that person is less likely to die. So the mortality rate, the force of mortality is decreasing as the person's age is increasing. So what do you guys think will happen to T? Would anyone want to have a guess? So let us say if my age is increasing, I'm less likely to die. So what will happen to my lifetime?
It will increase.
It will increase, right? So it will increase over x. So now what we observed was previously when the force of mortality was increasing with a person's age, my t was something like this. And now if my force of mortality is decreasing as my age increases, then I know that the chance that I will die tomorrow is lesser than the chance that I would have been dead already, right? So what I'm particularly saying now is that there is more and more chance that I will be alive tomorrow than that chance is that I'm alive today, right? So it's going to be an increasing function, something like this. So they have actually plotted the graphs for gamma function. And let me just maybe show that to you guys. So again, for gamma distribution, if we already know that if I have alpha equals to 1, which is just exponential distribution, what did we just conclude about the exponential distribution's hazard rate? That it is a constant always at lambda, right? So if I'm looking at lambda equals to 0.2, I can easily say that if I'm looking again at alpha equals to 1, which is just the exponential distribution, my hazard function would really just be a horizontal line which is constant over all the values of x, right? But now if you're looking at alpha less than 1, so let us see what happens if my alpha is less than 5. Oh, sorry, you'll get a heavier tail. Yeah, so you get a heavier tail here, right? This is the exponential distribution. This is one tail and this is another tail. So these two tails you are comparing now with respect to the exponential distribution tail that. Okay, this is not the graph of a particular distribution. This is only the tail behavior. This is only, zoomed out tail behavior. And which is why you see that exponential is that it is just a constant. This is in a way not the so it's all right. So if the value taken for particular x is higher than the exponential in the red case, which is what I see if my alpha is less than 1, then I know that for all the values of alpha less than 1, where it is a decreasing function of x, I'll have a heavier look at how you arrive at such reductions. Try to substitute in the values here. So these are three different scenarios of what you have. So this is the scenario where you have alpha equals to 1.
Ma'am, we cannot hear you. No, ma'am, we cannot hear you.